In the last episode, we covered documentary collections, where banks help move and release documents but do not make the same independent promise to pay that you would expect under a letter of credit. Open account terms go even further in the direction of trust and timing. They are common in international sales, and they can absolutely help exporters win and retain customers. But they also change the risk structure. When goods ship before payment is due, the exporter is no longer just selling product. The exporter is extending credit. In this episode, we break down why open account terms are really a credit decision, how they affect working capital, and what questions exporters should answer before shipment. The core risk shift is simple. Open account can be commercially useful, but it is not risk-free growth. The exporter ships goods or provides services before collecting cash. The buyer receives timing, flexibility, inspection time, resale runway, or production breathing room. That buyer convenience is exactly why open account terms are attractive. But the same timing benefit that helps the buyer creates exposure for the exporter. Until cash comes back, the exporter carries non-payment risk, late payment risk, and dispute risk. The receivable also becomes part of the exporter's working capital plan. That is why open account should be treated as a credit structure, not just a payment preference. Here's the basic sequence. First, the exporter ships goods or performs under the agreed terms. Second, the buyer receives the goods, documents, or services before paying. Third, the exporter invoices and funds the gap while waiting for the due date. Fourth, cash returns only if the payment timing, the buyer's credit, and the transaction performance all hold together. From the buyer's perspective, that can be very helpful. The buyer may inspect the goods, convert inventory, complete production, or collect from its own customer before cash leaves the business. From the exporter's perspective, the question is whether that timing benefit has been priced, limited, protected, or financed appropriately. This is where exporters effectively become lenders. In a letter of credit, the exporter is focused on complying documents and a bank undertaking. In a documentary collection, documents move through banking channels, but the buyer still drives the payment decision. With open account, much of that structure falls away. The exporter ships, invoices, and waits. That creates credit exposure because the exporter is relying on the buyer's ability and willingness to pay. It creates timing exposure because even a good buyer can strain cash flow if payment comes back in 30, 60, 90, or 120 days. And it creates dispute exposure because quality, documentation, logistics, or contract issues can delay collection while the exporter is still carrying the costs of the sale. That is why open account terms need real credit discipline. A credit limit is not just an administrative number in a system. It is the guardrail that says how much exposure the exporter is willing to carry before cash comes back. Before extending terms, exporters should understand who the buyer is, what the payment history shows, and how much exposure could be outstanding at one time. They should also look at concentration. Is too much exposure sitting with one buyer, one country, one sector, or one currency? Does the margin justify the tenor, the risk, and the collection burden? And what internal trigger forces a pause before the exposure grows beyond the plan? The uncomfortable question is what happens if payment slips? Can the exporter absorb the delay without disrupting operations? Is the documentation strong enough to support collection, a financing review, or an insurance claim review if one applies? Is recovery practical in the buyer's jurisdiction? Could country risk, currency controls, or political disruption affect timing or convertibility? And is the receivable protected, financed, limited, or simply accepted as part of the deal economics? These are not questions to answer after the invoice is already overdue. They belong before shipment, when the exporter still has leverage to adjust payment terms, credit limits, shipment timing, documentation, or the overall structure. Open account does not have to mean unmanaged risk. Depending on the transaction, trade credit insurance may support buyer non-payment risk, subject to policy terms, limits, exclusions, reporting requirements, and claims conditions. Receivables financing may help convert eligible invoices into working capital. EXIM Bank programs, private market coverage, MIGA support, stronger credit procedures, or different payment structures may also belong in certain situations. None of these tools is automatically better or easier than the others. The right answer depends on the buyer, country, tenor, amount, margin, documentation, and the exporter's cash position. Impello helps exporters evaluate those options and navigate the advisory path without replacing banks, counsel, carriers, or internal credit teams. The takeaway is this: open account terms can support growth, but only if the credit decision is intentional. They are not free, and they are not just a favor to the buyer. They transfer credit risk, timing risk, and working capital strain to the exporter. Before offering terms, exporters should ask whether they are comfortable becoming the bank and whether the exposure is protected, financed, or limited in a way that matches the business. In the next episode, We will focus on trade credit insurance for open account sales, where coverage can support growth, what it does not solve, and why policy details like limits, exclusions, reporting, and claims conditions matter. Subscribe so you do not miss it, and leave any trade finance questions you want us to break down next.